Here are 5 numbers. Each one represents a completely different Canadian life. Funded entirely by dividend income, completely tax-free inside a TFSA. $500,000 invested in VDY or XEI at 4.5% yield, $22,500 per year, $1,875 per month. Enough to cover basic living costs in a lower-cost Canadian city with modest spending. Combined with CPP and OAS at retirement, financially comfortable. $750,000 invested, $33,750 per year, $2,813 per month. Covers rent, groceries, utilities, transportation, and a modest lifestyle in most Canadian cities outside Toronto and Vancouver. $1 million invested, $45,000 per year, $3,750 per month. Covers comfortable living for a single person in most Canadian cities. Combined with CPP and OAS, a genuinely comfortable retirement. $1,500,000 invested, $67,500 per year, $5,625 per month. A dual-income household replacement. Comfortable lifestyle anywhere in Canada, outside of extreme major city costs. $2 million invested, $90,000 per year, $7,500 per month. Tax-free. Every month. Without ever selling a single unit. Without ever touching the principal. The portfolio keeps growing while the income flows. Here is the most important thing about every single one of those numbers. Every dollar of that dividend income inside a TFSA is completely tax-free. The CRA takes nothing. It does not affect OAS clawback. It does not reduce GIS eligibility. It simply arrives every month for the rest of your life. This video gives you the exact numbers, the exact ETFs, the exact timeline to reach each milestone, and a real Canadian case study of someone who actually did it, starting from almost nothing. Before we talk about ETFs, timelines, or portfolios, every viewer needs one specific number, their personal Dividend Freedom Number, the exact portfolio size at which their dividend income replaces their expenses entirely. The formula is straightforward. Dividend Freedom Number equals annual living expenses divided by portfolio yield, at VDY or XEI's current yield of approximately 4.5% in 2026. You need 22.2 times your annual expenses invested. At 4% yield, you need 25 times your annual expenses. At 3.5% yield, you need approximately 29 times. Here is the Dividend Freedom Number at different Canadian expense levels. The critical insight from this table. Most Canadians dramatically overestimate how much they need. Many Canadians in retirement, particularly homeowners who have paid off their mortgage, can live comfortably on $35,000 to $45,000 per year. At 4.5% yield, that is a portfolio of $778,000 to $1 million. That number, $778,000 to $1 million, is achievable for a median income Canadian who invests consistently over 30 years. At $500 per month at 8% annual total return, a TFSA grows to $745,179 in 30 years. Add RRSP contributions and the refund loop, and crossing $1 million in total registered assets is realistic for disciplined savers. The key distinction: you do not need to generate your entire retirement income from dividends. CPP and OAS together average approximately $1,668 per month in 2026. A portfolio of $500,000 in VDY, generating $1,875 per month, combined with $1,668 in government benefits, produces $3,543 per month, or $42,516 per year. For a debt-free retiree in a lower-cost city, that is a genuinely comfortable retirement. The Dividend Freedom Number gets smaller every year that CPP and OAS cover more of your expenses. Action step: calculate your personal Dividend Freedom Number right now. Write down your annual living expenses in retirement. Multiply by 22 at a 4.5% yield. That is your target portfolio. Then subtract the annual income CPP and OAS will provide divided by 4.5%. That reduction tells you how much smaller the required portfolio is when government benefits are included. Now that you know your Dividend Freedom Number, here are the specific Canadian vehicles that generate the income. VDY, Vanguard. FTSE, Canadian High Dividend Yield, Index ETF, current yield, approximately 3.3% to 4.5%, depending on the source and date. Motley Fool reports 3.3% in May 2026. Wealth North reports 4.5% to 4.8%. MER, 0.22%. Distributions, monthly. Holdings, approximately 50 of Canada's highest dividend-paying companies, dominated by the Big Six banks, Enbridge, Canadian Natural Resources, BCE, TELUS, and others. Since inception in November 2012, VDY has returned 12% annually, including price appreciation and distributions. VDY's one-year return to March 31, 2026, 41.16%. Three-year annualized, 22.79%. Five-year annualized, 17.39%. These are total returns, capital appreciation plus distributions, not just yield. XEI iShares S&P/TSX Composite High Income Index ETF. Current yield approximately 4.3% to 4.8%. MER 0.22%. Monthly distributions broader than VDY. Approximately 75 stocks across Canadian dividend payers. Slightly more diversification than VDY within the Canadian market. CDZ iShares S&P/TSX Canadian Dividend Aristocrats. Index ETF tracks companies with minimum 5-year consecutive dividend increase history. Yield approximately 3.5% to 4.0%. MER 0.66%. Higher cost. Dividend growth focus over maximum current yield. VGG Vanguard U.S. Dividend Appreciation Index ETF. Hold-in RRSP. U.S. Dividend Growth ETF. Lower current yield, approximately 1.5% to 2%, but strong dividend growth rate. Hold-in RRSP, not TFSA, to avoid 15% U.S. withholding tax under Canada-U.S. Treaty. The recommended Canadian income portfolio for living off dividends. For most Canadians building a dividend income strategy, VDY or XEI in the TFSA is the core vehicle. The monthly distributions, 4.5% yield, and 0.22% MER make them the most efficient income generators available. The honest trade-off, VDY and XEI, are 50 to 60% financials and 20 to 25% energy. That concentration means if Canada's banking sector faces a structural challenge, the dividend income may be at risk. Pairing with VGG in the RRSP adds U.S. sector diversification. Adding CDZ adds a quality dividend growth component. This is the practical income mix for $1 million invested. Monthly income, approximately $3,229. Tax treatment, VDY and XEI in TFSA equals $0 tax. VGG in RRSP equals tax on withdrawal, but deferred. Effectively, most of the income is tax-free. Action step: look up VDY and XEI on the TSX right now. Check the current trailing yield and the distribution history. Both ETFs pay monthly. Both have paid distributions consistently since inception. Both are available commission-free at Wealthsimple Trade and Questrade. Here is the most important practical section of this video. Because the portfolio numbers sound large until you see the timeline that reaches them. At 8% average annual total return, which reflects VDY's conservative long-run estimate, combining yield and modest price appreciation. Here is how long different monthly contributions take to reach each Dividend Freedom milestone. Time to reach $500,000. Generates $1,875 per month at 4.5% yield. A 30-year-old Canadian contributing $2,000 per month reaches $500,000 at approximately age 43. Having this invested in VDY would generate $18,750 per year. This is not life-changing money, however, it is money that you earn through passive investing. This supplementary income can help you slowly begin to live life on your own terms by buying back the most valuable asset for everyone: time. The time to reach $1 million generates $3,750 per month at 4.5% yield. The key insight from these tables: a 30-year-old Canadian contributing $1,000 per month reaches $1 million at approximately age 57, well before traditional retirement. At $1,500 per month, they reach $1 million by age 52, at $2,000 per month by age 48. These are not exceptional incomes. A Canadian household earning $93,000, the national median, saving 15% of gross income, contributes approximately $1,163 per month. On that contribution rate, a $1 million portfolio is reachable by approximately age 57 from a starting point of age 30. The Motley Fool Canada's May 2026 analysis confirms, with TFSA cumulative contribution room now at $109,000 for those eligible since 2009 and the $7,000 annual addition. A Canadian who has maxed their TFSA and invested in VDY since 2009 could already have substantial dividend income generating. The DRIP acceleration, enabling DRIP on VDY or XEI, means every monthly distribution automatically purchases additional units. Those additional units generate their own distributions. The compounding accelerates the timeline. At 4.5% yield with DRIP enabled and 3% price appreciation, the portfolio reaches critical mass faster than the 8% return table above suggests. Action step: find your monthly contribution in the tables above. Find your current age. Add the years shown. That is the age at which you could be living entirely off dividends before factoring in CPP, OAS, or RRSP income. Here is the case study that proves this is not theoretical. This is Reader B, a real Canadian investor whose story was published on Talkan, one of Canada's most respected dividend investing blogs. Reader B and his wife retired in 2004 at age 55. They had been working for 36 years. Neither had exceptional salaries. B earned approximately $110,000 in today's money. His wife earned approximately $90,000, both slightly above average. Neither had a massive inheritance or windfall. They started their investment journey with just $10,000. After 36 years of consistent dividend investing, they built a portfolio with a market value of over $8.5 million. The dividend portfolio generates $360,000 per year, $30,000 per month, in pure passive income. Reader B has lived off dividends since 2004, through multiple recessions and market crashes, without selling a single share to pay his bills. His approach: he targets a minimum 2% yield with a preference for dividend aristocrats that have a long history of growing their payouts. He deliberately avoids reaching for very high yields. He has held through every downturn: the 2008 financial crisis, the 2020 pandemic crash, the 2022 rate shock, without panic selling. His key insight, shared directly on Token: as long as companies do not cut their dividends, and quality dividend aristocrats rarely do, the income stream is stable regardless of what the stock price does. This is the practical proof of the dividend investing thesis. Not $8.5 million because he was lucky. $8.5 million because he started with $10,000 at above average but not exceptional salaries, invested consistently for 36 years, never sold during downturns, and allowed the dividend snowball to compound. The Token analysis notes that the total return approach, selling a set percentage each year, can be mathematically more efficient in theory, but it requires more discipline and is harder emotionally when markets are down 30%. For most Canadian retirees, a hybrid approach, dividend income as the foundation, supplemented with selective selling when tax-efficient, provides the best of both worlds. Reader B's $360,000 per year is the extreme outcome. The median outcome for a 30-year consistent contributor at $1,000 per month is $1 million, generating $45,000 per year. Both are built with the same mechanism. Only the starting amount, salary, and time horizon differ. Action step: calculate what your own version of Reader B's portfolio might be worth. Take your current monthly contribution. Multiply it by the compounding factor for your time horizon. The number is more achievable than most Canadians believe. Here is the complete action plan. From opening an account to reaching your Dividend Freedom Number, in the correct sequence. Step 1. Calculate your Dividend Freedom Number this week. Annual living expenses in retirement times 22 equals your portfolio target at 4.5% yield. Subtract the CPP plus OAS government income equivalent, your projected combined CPP plus OAS, divided by 0.045 from the portfolio target. The reduced number is your actual required portfolio after government benefits. Write this number down. It is your target. Every other financial decision should be oriented toward it. Step 2. Open a TFSA at Wealthsimple Trade or Questrade. Commission-free, online. Takes approximately 20 minutes. Check your current TFSA contribution room in CRA My Account. If you have been eligible since 2009 and have unused room, up to $109,000 in cumulative room is available. Step 3. Buy VDY or XEI inside your TFSA. VDY and XEI are both available on the TSX. Both trade commission-free at Wealthsimple and Questrade. Both pay monthly distributions. Purchase whichever you prefer, or split evenly. The yield difference between the two is marginal. Step 4. Enable DRIP immediately. In your brokerage account settings, enable dividend reinvestment on VDY or XEI. Every monthly distribution immediately purchases additional units automatically. The compounding begins from your first distribution. Step 5. Set up an automated monthly purchase. Set a recurring monthly transfer from your bank account to your TFSA on payday. Even $200 per month, even $300. The automation removes the monthly decision. The system runs indefinitely. Step 6. Add VGG in your RRSP for U.S. diversification. Once your TFSA is established and growing, add VGG, Vanguard U.S. Dividend Growth ETF, inside your RRSP. U.S. dividends in the RRSP are sheltered from the 15% withholding tax under the Canada-U.S. Tax Treaty. This adds U.S. sector exposure, technology, healthcare, consumer staples that VDY and XEI lack. Step 7. Never stop DRIP during market downturns. When markets fall, VDY's price drops, but the distributions often continue. DRIP buys more units at the lower price, permanently improving your yield on cost. A market correction is not a threat to a dividend investor with DRIP enabled. It is an accelerator. Stay invested. Keep DRIP on. Let's come back to where we started. 5 numbers. 5 Canadian lives funded by dividend income. $500,000 at 4.5%. $1,875 per month. $750,000. $2,813 per month. $1 million. $3,750 per month. All tax-free. All monthly. All inside a TFSA where the CRA takes nothing. A real Canadian couple, Reader B and his wife, started with $10,000 at slightly above average salaries and built $8.5 million over 36 years. $360,000 per year in dividend income. $30,000 per month, without selling a single share through any crash or recession since 2004. You do not need $8.5 million to live off dividends in Canada. For most Canadians, the goal is $500,000 to $1 million. At the median household income of $93,000, saving 15%. That is a 21 to 27-year journey. Starting at 30, you arrive at 51 to 57. Your Dividend Freedom Number, with CPP and OAS factored in, is likely smaller than you think. A $45,000 per year retirement lifestyle requires only $555,000 in VDY when CPP and OAS cover $20,016 of that annually. Open your TFSA. Buy VDY. Enable DRIP. Automate monthly contributions. Add VGG in your RRSP. Never stop during downturns. The dividend income machine is one of the simplest wealth-building systems ever designed. It requires no active management, no market timing, no stock picking, and no financial expertise beyond what this video just gave you. The question is not whether you can build it. The question is when you start.